We're very excited today to hold this webinar on what we perceive to be an increasingly important issue of ESG disclosure and diligence in the context of equity capital markets.
As we all know, sustainable finance has become increasingly important, and a good question, I guess, is why. Some companies see a civic responsibility to address climate change and environmental impact, as well as other matters that might affect their stakeholders and employees. And investors seek sustainable investment for many of the same reasons. In addition, regulators and policymakers have made it clear that sustainable finance will be increasingly important in their analyses and rulemaking, as evidenced by the recent EU taxonomy on sustainable activities and similar ESG-related regulatory and policy pronouncements. In response to this, we at AFME have formed a Sustainable Finance Steering Committee to coordinate our ESG work, and numerous AFME divisions are working on ESG projects related to their specific subject matter or product areas.
COVID-19 has only shown that companies that understand and are addressing ESG risks appear to be more resilient. Is also drawing attention to how companies understand the social environment in which they operate and how they are or may not be perceived in civil society. The Black Lives Matter movement shows how quickly change can happen and how companies will have to adapt or respond to social shifts. I think, at the London Stock Exchange, as a global financial markets infrastructure group and at the heart of the financial markets, sitting between investors and those seeking capital, I think we've got quite a unique position with the information services division part of the business with FTSE Russell, supporting the sustainable investment strategies of the world's largest asset owners and asset managers for almost 20 years, really since the launch back with the FTSE for Good index. And this has given us a really deep understanding of their evolving needs and that broad global ESG data set that has come with that. And we've now got over more than 100 ESG themed indices that underpin a variety of different sustainable finance and investment activities. And then we have our capital markets division with London Stock Exchange and Borsa Italiana, and that's a strong, focus areas for there in sustainable finance. There's three core areas of focus for us there. It's about helping our issuers to understand and deliver best practice in ESG and climate-related disclosures. It's also about enabling access to capital for new growth businesses in environmental products and services. And it's about enabling all of our issuers to access capital to transition their businesses to sustainable, low carbon business models. Despite COVID-19 and the coming economic challenges, climate-related risks and opportunities remain a huge focus for investors. I mean, we only need to see what BP's announcement that it's writing off more than $17 billion as part of a result of reserves it may not be able to exploit due to climate change really demonstrates the scale of the issue. Regulators are also very focused on it, and TCFD is the current focus of both groups to understand and measure it. Hence, we're looking to help issuers understand how to approach this over the next 18 months in the lead up to COP26. I think the social and economic impacts of the pandemic are profound and will require many businesses to review their business models and their corporate purpose. However, I think there are two clear themes that have emerged relating to sustainable investment. Firstly, the resilience of stocks that have a strong performance, which has further demonstrated the value of company management understanding and acting to manage risks and opportunities that are often thought of as externalities. Secondly, I think the significant attention being paid by business leaders and policymakers on building back better or the green recovery packages. This may mean that companies with demonstrable transition strategies are at an advantage when raising capital, as well as those that have got the necessary products and services to build a more resilient low carbon economy.
As Claire has briefly mentioned, due diligence continues to be an integral part of capital markets transactions, including equity capital markets. I'm excited to be joined today by 4 distinguished panelists who will provide their views on ESG due diligence and ECM transactions and will address the audience's questions on this very important topic.
At the outset of the crisis, when I did think about this, I was pretty sure that ESG was going to actually start to drop down the list of priorities for management teams and investors, because the crisis, when it started, was so all-consuming. It was all about survival. So the first transactions that came to the market, like SSP and a bunch of others that we all know about, were all about companies in an existential battle to survive the crisis and get enough liquidity so that they could carry on paying their bills. But I think I've been comprehensively proved wrong about that, and ESG has remained at the top of the agenda. And actually, it's accelerating how companies think about this stuff, and they're realizing that it can be a competitive advantage. And that they need to, if they had started gently to think about these things, they're needing to think about them very, very rapidly now.
The word I have written down here is indeed accelerant. I think I had a similar reflection to Ben, I think, at the beginning of all of this, because the 2008 crash, I think, did drive environmental issues off the agenda. That was very noticeable. And as an environmental practitioner at the time, it was a very kind of interesting process, and people prioritised in different ways. But there are a number of distinguishing features today that lead me to be much more optimistic and come to the conclusion that you've heard. And I completely agree with Ben in terms of people's kind of priorities and focus. I think also this is one of the few major economic shocks which has been, or you have to go back a long way in history, let's put it that way, which has been physical and not purely fiscal. I mean, fiscal has followed, but it's been physical. And I think it's also reminded folk of the importance of human capital. And it's a horribly kind of economic characterization of people. But that echoes when I speak to clients around the world. There is just a deep reflection on the importance of human capital and supply chain resilience. So I think there's that element. There is also, I think, one other element, and I don't know where this will go, but the timing of all of this around the European Green Deal, which I think is probably the most significant environmental program globally that we have probably ever seen, without being overly dramatic about it. If you combine the ambition in that program with the recovery plans, then there is an enormous opportunity to redirect capital flows into what you could very broadly call ESG based investments and sectors, and then that will drive fundraising through the capital markets. And you also, if you combine that with, you now have the platform for many governments having a degree of state intervention, which they probably haven't had since World War II, I think makes the kind of, I'm a humble lawyer, not an economist, but it makes the kind of framework in which the ESG factors are considered really quite unique. And I think, for me, it lends itself to the conclusion that we are in a very different space to where we were in 2008.
We are seeing that retain, and it will endure more easily this time, but the focus does remain on the financial side when we're involved in transactions. And there's one I'm involved in at the moment where issues of well-being and health and the environment is at the very bottom of the list of priorities at how that transaction is going to proceed. Beyond tax and pensions and IT. So although we continue to emphasise the importance of ESG issues, it does tend to get prioritized, or at least it's limited to where there is a clear link or clearly understood link between the issue and the financials. So you take something like environmental liabilities, which can quite clearly be, can be calculated and end up on a balance sheet, and there is a financial value to that can be attributed to that. But we are starting to see that movement though, beyond those issues of compliance and only thinking about the risk and the downside, and starting to move towards how can we maximize the value that is associated with our ESG performance as a corporate. And if you're an investor, where can we extract greater value from considering ESG within the decisions that we're making? But that gap really remains between the expectations that issuers have and investors on this. So the investors are looking for that information and they're not really getting it from the issues to the extent that they'd like to see. And if you look at that disclosure, it's something like only 25% of the information that is put out by corporates is subject to some form of external assurance. So there's this big gap between the information that ends up in the market and whether or not it's been subject to scrutiny, and does it have robust underpinning processes. So for all the growth in ESG type funds, we need to sort of tread a little bit carefully in terms of how much rigor they are being subject to, and if we genuinely believe that a considerable proportion of the value of a company is intangible, and there's plenty of evidence that shows that the percentage of intangible value has grown over time, we should be looking for the same degree of rigor in the processes that look at that information as we should on the financial side, and we're clearly not there yet.
When starting to work on a specific transaction, I think the due diligence will have to be angled in a way that we cover basically what is the sector-specific areas of concerns and opportunities for that company. So I think what underwriters need to ask themselves is, what is the ESG role in this sector in which the company operates? What are the key metrics that we need to track and that people are looking into? What are the best-in-class peers doing? I think the second angle would be the company specific. So what kind of internal resources is the company committing, for instance, to ESG initiatives? Do they have appropriate corporate governance systems, controls? What about human capital development, which I just mentioned? What are the stakeholders of the business? And then there will be two other angles. I think one will be the regulatory requirements on which the company will be operating on, and then the other one will be the investor base. So what are the investors that are looking into this? So I think those are the key general due diligence question approach that we need to ask themselves when looking into a transaction. I think in parallel to all of this, I think we will have to look into the type of transaction. So the reason why ESG has been, I think, a bit more prominent in DCM is because the use of proceeds can actually be more traceable to ESG. Whereas in ECM, you have secondary transactions where it's harder to actually position the ESG angle, and it's more embedded in the strategy of the company and not so much on the transaction rationale. So I think there's all those elements that we all need to put together and then go ahead and just try to merge the due diligence and the disclosure when working on a transaction.
We've still got plenty of areas in our capital markets where France differs from Italy, differs from London, etc., etc. So to the extent that under the ESMA banner, ESMA can make sure that how we approach both diligence and disclosure on ESG is consistent as possible across those jurisdictions, and that is going to be helpful.
So as a brief commentary on the disclosure framework, as referenced on the previous call, this is not new. There's always been an obligation to disclose material information in prospectuses. What has changed is the focus and the importance of ESG. And whilst there's been a growth in the rules and regulations, as referenced on the previous session, we're very much at the beginning of the debate as to what ESG information should be included in disclosure. And I think there are a number of very important questions which we will reference and try to respond over the course of the next 45 minutes. But what information is material for investors, and how does that vary between companies? And where do you look for guidance as to what information is material? What frameworks, what rules? What is the nature and extent of that information? For example, quantitative data. What type of quantitative data is required? How do we verify that information? And what are the risks and liabilities attached to that? To what extent are these answers influenced by rules and regulations in other areas, such as the rules and regulations that apply to investors or those that apply in the context of producing annual reports and accounts? And I think it's important to reference that practice will evolve. Disclosure standards are not static. So some of what we discuss now might not be immediately applicable, but may become applicable in the future. And again, to repeat a comment that was made on the previous session, COVID-19 has somewhat turbocharged the debate and made these issues very live.
From my perspective, there have been two fundamental changes or shifts in investor needs. On one hand, what we've seen is that there is a change of the center of gravitas, or the center of attention, from companies to investors. This is basically what this means is that, of course, we still need detailed information from companies in order to assess their performance, but more and more it becomes important to respond, to comply with regulation, but also to respond and meet the expectations, market expectations, our client expectations, and to meet our commitments. In practice, this means that the accent is increasingly put on at portfolio level and at firm level, being the firm, in our case, BNP Paribas Asset Management. Portfolio level means that I have to disclose now the percentage. Well, in a few months, I'm going to start, or a couple of years, I'm going to have to start disclosing what is the percentage of my fund that responds to the taxonomy, the green taxonomy. Therefore, I'm going to have a real incentive to increase that exposure on my funds, because that's going to become more and more an indicator that our clients are going to use to compare, funds. It is the same thing in terms of reducing our carbon footprint, improving the board diversity, and in many other aspects. We're going to search more and more to be the benchmark and for our performance at portfolio level to be better. I just want to recall everyone that the EU disclosures regulation might still not finalize, but might make more than 32 indicators compulsory for investors at firm level. So that means that also what is the overall footprint of BNP Paribas Asset Management becomes more important. In practice, this what means is that there is stricter and increasingly more stricter ex-ante systematic filter, even before I start assessing companies. And you can start thinking about what are the consequences of that. So those companies that don't pass the filter, they don't even get to be properly assessed. The second point I want to make is that the importance of the double materiality, the concept of double materiality. This is a de facto reality for any investor, any European investor, because the disclosures regulation already enacts that. And the debate today is whether or not it should be enshrined as part of fiduciary duties. Basically, for those who are listening to us, what the double materiality means is that it's important not only the ESG risks to the investment, but also the impact of the investment on society and the environment. And this is particularly important because it puts the accent, or it highlights the importance of the common good and the need to capture carbon market failure and to address systematic risk.
In terms of the disclosures around ESG, there are really two sources that we are using now centrally at S&P Global. The first is Trucost environmental. So that is where we capture the disclosures and where there are gaps model to cover a universe of 16,000 public listed companies. And for the broader E, S, and G topics, we draw from a group called SAM, which is an ESG data gathering team based out of Zurich, covering 7,000 companies. And we gather the information from those companies based on a questionnaire, which is called the Corporate Sustainability Assessment. So there's about 60 to 80 questions, a deep dive look at sector-specific issues and covering all of the topics of E, S, and G. So, for example, greenhouse gas emissions, or for social, for workforce and diversity, or safety management, for governance around structure and oversight, code and values, etc. And then, depending upon the financial materiality, apply a weight to those different metrics in order to develop a score for the company on its ESG performance.
And then, as mentioned in the previous panel, you had the challenges around due diligence on these, particularly given the developing nature of ESG generally and some of the KPIs, which I think leads into something that Jason was mentioning around framework, is that there's obviously a wide variety of both governmental and let's call it an industry body guidelines and suggestions out there. And not really an integrated framework, but B, also there are not necessarily integrated KPIs across sectors or issuers generally. I think, maybe with the possible exception of scope 1 and 2 greenhouse gas emissions. So I think that would be a challenge from a liability perspective, that if an issuer is considering putting in KPI or target type of disclosure, making sure the reader understands exactly how that metric is being calculated. And I think the AFME and is a response to the recent consultation on the NFRD is a good illustration of some of the challenges presented by that topic.
Given where we currently are, given the lack of uniformity of standards, and in particular, given the lack of external third-party ability to verify information, there is a tremendous amount of risk that companies are exposed to by voluntarily over-disclosing. And I know that's not necessarily going to be the most popular answer, but I unfortunately think it's a pragmatic answer within the framework of which companies are operating as a legal environment in which they get sued. And ultimately, look, even putting that aside, it's not helpful to investors if, in my view, if the information that people are providing, they think they're doing the right thing, but ultimately not that reliable. It could be potentially misleading because it's being prepared with the best of intentions, but it's not benchmarked. It's not informed with respect to others within their sector, within their market.
We just wanted to mention that each speaker in today's discussion was participating on an individual basis. So that means that the views of the speakers might not represent the views of their firms.